Good afternoon, everyone. My name is Jordan Lee, an ETF specialist at JPMorgan Asset Management. So what an ETF specialist means essentially is that I bring out global exchange traded funds from US, Europe, and Asia and bringing them to be made available in Singapore. Now I want you to think about two words, consistent and calm. Now this year has been anything but consistent and calm. The only thing consistent is how inconsistent the trade policies have been, and there's an additional layer of anxiety from just geopolitical tensions. Now, obviously, with it being an ETF festival, and earlier in the morning, if you're a part of it, you might have heard from my industry partners about the importance of ETFs. But during these times of uncertainty, investors do need options. Investors need options on how to invest and where to invest. My short answer for you today is active ETFs. Now, active ETFs is not just changing the way we invest, but it's also changing investing as a whole. Now, think back to 2008. Post GFC, what has happened, right? $7 trillion was wiped out from the Asia stock market. Singapore, being a very globally connected economy, we were the first Asian economy to fall into recession. But ever since 2008, what has changed since then? Well, investors wanted more transparency, there's more technology advancements, and there's more safeguards in regulations. But what else has changed since 2008? Well, let's look at the mutual fund industry. 3 times. That's how much the mutual fund industry has grown from 2008 to where we are today. There's 20 trillion to 60 trillion. Now, what else has grown and evolved since then? 10 times. That is the growth of the global e-commerce industry. So think your Shopee, Lazada, Taobao. Something that we are all very used to today, and I'm sure all of you must have bought something from Shopee before. In 2 days' time, it's 7/7 sale, so don't forget to pay your voucher, add to cart, yeah? Okay? But now think about something that is 20 times. That is something that you must have noticed that growth. And that is how much the ETF industry has grown in the last 15 years or so. But ETFs weren't created in 2008. ETFs was created in 1992. But post-2008, the industry has supercharged and has reached to what we see today as a $15 trillion industry. And in the next 5 years, we expect that to grow to $30 trillion. And that's because the ETF industry has simply doubled every 5 years or so. Now, why is it that the ETF industry supercharged itself post-2008? It's really because of 3 main reasons. The first one, investors wanted more transparency. And what that means is that investors wanted to know what they were investing into, what it was in their investment portfolio, what was every single security that they were holding and not holding. The next reason, investors wanted liquidity. What that means is that to access their investments whenever they want to, whenever they need to be able to buy an investment, and more importantly, to get out of the investment, to be accessible to it on exchange through your mobile phone, through your broker right now. And the last reason that supported the ETF growth is because of cost. Investors wanted to know what they were paying for, exactly how much they were paying for it, and to be cost effective without unnecessary fees. Now, when you think about these 3 features of transparency, liquidity, and cost, are they features of a specific investment strategy? No, not really. Are they features of a specific asset class? Also no. Are they features of a specific fund manager? Also no. All 3 are features of an ETF. And that's what supported the growth of ETF to where it is today. But today, I'm here to talk to you about active ETFs, not just ETFs. So what is ETFs? What is active ETFs? As the name suggests, it is active management. And active management is tapping on the research capabilities of those managers that you and I may not have at home. So over here at JPMorgan, we employ more than 1,000 investment professionals. That's across US, Mexico, Japan, even Singapore. We have people looking at every single security, every single company. And the plus point of that is that we are able to select the securities that we like and also exclude the ones that we don't like. Now, when you look at the ETF structure itself, of transparency, liquidity, and cost, these two structures have been very successful on its own. You see the active management component, and you see the structures of ETFs. What is an active ETF? You basically just combine the two to make something that was originally very successful on its own, and now creating an active ETF like the one provided by JPMorgan. So we talk about the growth of ETFs. When we look at active ETFs growth as a whole, active ETFs growth is faster than any other type of ETFs currently. And so we expect it to grow to $6 trillion in the next 5 years. And that's doubling every 2 to 3 years or so. And the reason for that is the same reasons that make passive ETFs successful. What has driven ETFs to a $15 trillion industry today is the same reasons that will drive active ETFs from today forward. And that is transparency. Knowing what you hold, taking ownership of your own portfolio, knowing every single line item that is managed by the investment manager. Liquidity, to be able to access those investments, and more importantly, to get out of those investments when you need to, whenever you need to. And last but not least, cost, where all of you, I'm sure, are concerned about cost. Now, at JPMorgan, we are very fortunate to be managing investments on a global scale. What that means is that we have investments across the world, managing it for different investors, from sophisticated, high net worth investors to financial institutions to investors like yourself. And when you look at the average fee of an active equity fund in Singapore, it's about more than 1%. And the reason for that is because, like I mentioned, investment professionals, the research capabilities, the insights, those has to be factored for. But because JPMorgan has that skill to manage things on a global level, our active equity ETFs are priced at 33 basis points. Now that's 75 basis points of management fee that you save just by investing in an active ETF managed by JPMorgan. Now, at JPMorgan, we are committed to the cause. We want to be a leader in the active ETF space. And the reason for that, the result of that is that we've been privileged to be the manager of the largest active equity ETF in the world, the manager of the largest active fixed income ETF in the world, and the manager of the largest active ETF in Europe. Now, when you think about active ETFs as a whole, there are many different use cases for it. If you want a cash plus product, just because fixed deposit is not working out for you, you want something to step up a money market fund, you have that in an active ETF format. If you want something more high concentration, high conviction, really tapping on the expertise of the portfolio manager, you have that in an active ETF format. If you want something to generate income, a goal-based investing, you also have that in an active ETF format. Now today, I also want to talk about the JPMorgan Equity Premium Income ETFs. These ETFs are our global flagship strategies and we have decided to bring them to Singapore, accessible to you and myself. Essentially, they are JEP, JEPQ, and JEPG. What you can think of it is essentially the S&P 500 one, the Nasdaq 100 one, and the MSCI World one. Now, what are these strategies? In short, they aim to deliver consistent income even during periods of uncertainty, to monetize that volatility, and to deliver that consistent income and giving you that calm smoothing of investment journey. So what's the result of such ETFs? I'll let you internalize that slide, but essentially is to deliver that income. So when you look on the left hand and right hand side, you have your JEP and JEPG, where the historical 12-month yield is about 7+%. But typically, we do expect this to be on an annualized basis of around 7 to 9%. And right in the middle, JEPQ, the Nasdaq 100 one, that really fits into that volatility, feeding into that uncertainty. Where we see there the 12-month yield of 12-ish%, we do typically expect that to be around 9 to 11%. Now with the uncertainty, this provides you a level of consistent monthly income, even when we are not sure how tomorrow is going to be like. Now the next thing you're going to ask me is, Jordan, sure now, this sounds too good to be true, and how does these ETFs work? I'll tell you upfront what's the catch. The catch is that you may forego some of the upside. But looking into how these ETFs work, first bit, you do have the underlying equity portfolio, very similar to what you're familiar with today. In the market, it may go up, it may go down. That is the capital component. Next, you have the income. First, you have the stock dividends, which again, you might be familiar with, the stock dividends that paid out from your underlying investments, the equity portfolio. But what is unique to this portfolio is that this portfolio sells call options on the index to deliver the additional income. Now that sounds a bit complicated, so think of it as like selling insurance. When you sell insurance, you get a premium, and investors do buy and purchase certainty during uncertain periods. So what that means is that during periods of volatility, people are willing to pay more for the insurance. And when you combine those two components, the stock dividends as well as the selling of those call options, you do get a consistent income. And when you combine all three components of the underlying equity portfolio that you hold, be it S&P 500, Nasdaq 100, or the MSCI World, plus the income, you get an overall smoother investment experience. It provides you a calm in your investment portfolio. Then the next thing you're going to say is, Jordan, since this strategy is so good, what scenarios will it work well, what scenarios will it not work well? I'll be upfront with you. In a bull market, that's where the catch is. That's where you may forego some of the upside. But if you tell me today that you think that in the next 1 year, 3 years, or 5 years, there's only going to be a bull market, and the market's only going up with no volatility, then this strategy may not be for you. But also at the same time, if your concern is the worst case scenario is that the market is going up, I don't think that's too much of a concern for your own portfolios. But in a bear market, this strategy helps you to deliver the income, to help protect the downside, to help smoothen the total return experience, so that every month you have an expectations and you know what it's going to be like. It helps you sleep at night. And last but not least, if it's a flat or sideways market, where you don't know what tomorrow's headlines is going to be, what new tweet or post will change the market, where there's a lot of volatility and uncertainty in the market, then this strategy allows you to stay invested, participate in the upside, and still deliver the income. The idea of these strategies of selling call options on an index is not really new. Large financial institutions have been using it for many years, using call options as a strategy for their investment portfolio. But prior to active ETFs, you needed scale to be able to access these strategies. So what we are doing differently is that right now, we have packaged these type of strategies into an active ETF format so that you'll be able to access them and still have the benefits of transparency, liquidity, and cost. You'll be able to access these active ETFs through JPMorgan. You'll be able to access these ETFs through JP, JQ, and JPG. Now, to wrap it all up, consistency and calm. This year has been anything but consistent and calm. But with these three ETFs, it helps you give a consistent income and total return experience. It helps you monetize that level of volatility, where traditionally volatility may be a bad thing, but with such strategies, you're able to monetize it, sell out at premiums, and capture that income on a monthly basis. And last but not least, it helps you protect on the downside, mitigate the market drawdowns. And because of all that, it offers you that calm, the smoothing of the investment journey that you may need in your portfolios going forward. And you're able to access them through these three tickers of JP, JQ, and JPG, all through your mobile phones, all through the broker today, through the FSM platform. Now, I've mentioned a lot, and there might be questions, so we do have a booth on the other side where we have an interactive gate as well as sports hours if you need it, so I'll be over there as well. So, looking forward to having a chat with all of you. Thank you.